before we get too far into it, we'll talk about Ryan's design agency here. So to give you a little more context, as Laura mentioned, they're a design agency, they're growing, and they've got this job that they're working on that they're really excited about. It takes a lot of time. What the real key piece here is that, like most design agencies, they're working on a big project and they're about 50 to 60% of the way through. And once the job's done, they'll get the remainder 40%, 50%, whatever that looks like at the end of job completion. And so in this case, we're saying that's going to be $40,000. So they also want to hire a team member because they're jam-packed with work and they want to continue growth. They want to grow their business. They don't just want to stay static. So going back to working with confines, we've got a really good use case here in terms of you've got a company that's outlaying cash in terms of their employee costs upfront. They haven't received all the money yet, and they need to start hiring new people to continue their growth trajectory. But can they do that? Like, do they have enough money to do that without that last lump sum payment, that 40 grand that's coming out? And if that payment moves, does that affect them? So that's just kind of laying the land. I don't think this is a description that's, exclusive to Ryan's agency. I think this could be any number of businesses out there. I think it just gives some really good context in terms of what we're trying to look at here. So first things first, we'll create Ryan's company. So we'll call it Ryan's Design Co. And we are here in Mountain Standard Time in Canada. We'll just pick that. And we'll create a company. Here you can connect to QuickBooks or Xero. And what we're going to do, our demo data is in Xero. We're not picking favorites here. That just happens to be where our demo data is at. So the process is as simple as logging into your ledger system. This will be the same for Sage users in the UK. You pick your demo company. In this case, this is Ryan's company. And we'll make the connection. And so what Helm is doing here is it's starting to search some of the past data, and it's starting to make some calculations for you in the background. It's basically replacing all of the effort that I was putting into the spreadsheet up front, those 2 to 3 hours that I was spending in terms of creating the spreadsheet, manipulating it, changing all the formulas. We're doing a lot of that upfront work here. So looks a little basic right now, but we'll be building this out as we go. And so I just first wanted to touch on what is this? Because as you can tell, it looks very different than what our spreadsheet did. And there's a reason behind that. We found that in talking to small businesses, the spreadsheet really confused them. Their eyes glazed over, they didn't understand it. And so we designed Helm to be very visual. So this top line graph is simply your bank balance over time, moving into the future. So as we change and we do forecasts and we create assumptions, you're going to see this move up and down and do a bunch of zigzags. But this is where your bank account will be on any given day from now and into the future. On the bottom of the graph, we've got what we call transactions. And so the transactions graph, and this is just an overlay of individual items in the system. So anything above zero is a cash in, and anything below zero is a cash out. This happens to be accounts receivable, and it's an inflow. And you can see the size of the bar is essentially the amount. So here we've got a $6,000 bar, whereas here we've got a $900 bar. The reason that that was built that way is so that you focus on what's important. You focus on the big stuff because the big stuff makes the most impact. So we'll start by looking at the bank balance. There's really not too much to look at here. What Helm does is it connects to any bank account or credit card in your accounting system, whether it's Xero, QBO, or Sage, and it pulls out the reconciled balance. We want to use the reconciled balance because in the case here in North America, people still like to cut checks, and sometimes those checks do not clear the actual bank account, but they are cut out of the accounting system, and that makes sure that it's more accurate. Then we go into accounts receivable, and we take a look here at what we've got in our listing. The nice thing about Helm is we can calculate what we call average days receivable. So this is actually using the data that we pulled, and it's making a bunch of calculations in terms of how our customers pay us. And so you can see immediately our graph changed. And that's because we've got accounts receivable in the system, and Helm calculated how these customers have paid us in the past. and it's telling us how they will then be paid. That's dictating how they will then pay us in the future. Is it 100% accurate? No, but most people forecast based off due date in terms of receivables, which is usually inaccurate because most people pay how they want to pay. And so you can see here, even though this company's terms are 30 days, you've got some people paid in 22, 56, 41, etc. But Helm takes that information and maps out accounts receivable timing for you so that you don't have to. So you can see, as opposed to our spreadsheet where we made very basic assumptions about when stuff's coming in, Helm automates this for you and it maps it out for you so you don't have to. You have to spend zero thought on this. It just simply does it for you. Outside of maybe you talk to City Limousine and they're now paying in 30 days because 56 is a little ridiculous, and you've created some new arrangement and you punch in 30 days here, Helm would calculate that out for you now. So you can change it, but it's giving you reality first, and it's creating your forecast for you based off that, so you don't have to. And that's a huge time saver. It not only gives you a ton of accuracy, but if you were imagining trying to do this for every individual customer, calculate their payment terms, that would be a ridiculous amount of effort. Like, that's why people don't do it. So huge bonus there. We do the same thing with accounts payable. So we'll simply click ADP. Appreciate again that people have their own due dates, but again, people pay how they pay. And so you can see again that our graph changed and our payables are now spread out over time based off how we pay our bills. Then we'll go into forecasting rules. So now what I've done to this point is simply go through the accounting system, which is all past looking information. As with any forecast, you need future looking information. You need to know what's going to happen. So you need to create your budgets. You need to pick those payments, that tab that I had in terms of recurring payments. We need to do that. We need to map all of that out. Here we click generate rules. And what Helm's doing is it's going through all that data pulled, it's making calculations, it's trying to find recurring entries, and it's creating budgets on top of that where it can't find recurring entries. And so I'll just close this for a second. But you can see here that, you know, with a few clicks and in a couple of minutes, we've actually got a pretty good forecast built based off past history. And so what used to take me hours was really done in minutes. And, you know, that's maybe being a little bit unfair because we haven't put any thought into this, but we'll start walking kind of through best practice, so to speak, right now in terms of setting up a forecast. We're just highlighting that the pain and frustration that I had in 2080 in terms of setting up all of the data, manipulating it, managing it, that's all been eliminated. We really want to get people to that decision point. We really want to help them map out their business and make really good decisions as quickly as is possible. Bonus, we don't have to worry about breaking any formulas. And another bonus, we don't have to hop through about 1,000 different screens. We just clicked 3 buttons. Here we are. So now keep in mind, our system is based off algorithms. And so algorithms can be wrong. Nobody could have predicted COVID. So if you use this system right when COVID was happening, it would have been dead wrong, just like every forecasting system out there, just like Excel, nobody could have guessed it. So you always want to review your forecasting rules, and the forecasting rules are literally just logic. It's budgets and estimates for what you think are going to happen. We want to review these to make sure that they're right. So the first one I kind of want to pick on is payroll, because that's obviously one that's pretty important. And it can be kind of missed in the system sometimes, depending on how much journal entering you do, how many off pay runs you do, how variable you make the data look. So Helm's really good at picking out consistent recurring data. And you would think that that would be a payroll in terms of, say, biweekly payroll. But if you do a ton of journal entries into it, a ton of adjustments, a ton of ROEs here in Canada, so people getting terminated, it'll actually make the data look variable. It'll make it look random. And so the system has a hard time detecting it sometimes, and it'll just make a highly simplistic assumption in terms of, well, in any given month, we are now spending $16,600. The reality is that I know that this is a biweekly pay run. So this is a great example of, I just want to take my knowledge of my business or my client's business, and I want to apply it. And this would be the same in any spreadsheet. I would be calculating a 12-month average, and then I would be adjusting it to what reality is. So here we're going to say, I actually want this to be a bi-weekly pay run. We're going to start it on May 9th. It's going to happen on a weekly basis because it's bi-weekly, so every 2 weeks. Day of the week doesn't typically matter, but if it does, you can change it to, do you run it on Monday, Tuesday, Wednesday, Thursday, or Friday? We'll click save for that, and that'll actually change our forecast on the side. But of course, the amount is not $16,000 every 2 weeks. It's actually $8,333.33 every 2 weeks. So we'll change that, and you can now see how the graph has changed to be very much up and down within a month. And I think that's really important to note, because if you think about most businesses, 60 to 80% of most costs in a business are related to two things typically, and that's people and rent. And people are paid typically twice a month. And so this is a very typical cycle of cash in a business where you get a high in terms of your earnings going up, and then all of a sudden it gets a big drop because you made a pay run. And going back to accuracy matters, this is why accuracy matters, because if you're in a negative position at any point here, you need to know that. So that's just a quick show of how you can change a monthly average estimate into a bi-weekly pay run example. So another good one to pull out is insurance. So here we've got an insurance budget of $416. Now the reality is that I know this business may be a little unfair in terms of you don't have the context, but here we actually pay this insurance annually. And so Helm didn't detect it because there's actually not enough data in our demo company for it to detect the annual recurrence. If there was 2 to 3 years of data, it actually would, but it didn't in this case. I know that this $400 is wrong, and I actually know that it's $6,000 per year. So I'm going to change this. I can even change the name to annual insurance payment. And we are going to say that this actually happens in July on the 15th. And it happens annually once a year. And again in July, excuse me. And we'll set it to $6,000. So you can see here, right there, we've got our insurance payment. So you can see here that it dropped out. So again, instead of smoothing it out and giving us a P&L view, an inaccurate view of what our cash flow is, we've now got a more granular, detailed view of what happens. And keep it in mind that I'm just reviewing this information on setup. Now that it's in the system, it's always there. It just simply recurs every single year. So until I change my annual insurance payment to August or the amount, then I change the amount and the timing here. So same thing as a spreadsheet. Another thing, good thing to note is Helm only surfaces for the forecasting rules profit and loss information. And the reason that we do that is because there's a lot of accrual items, so prepaid expenses, accrued liabilities, that can create some double counting if you surface both the profit and loss and the balance sheet at the same time. Insurance is actually a great example of that, where you've got both prepaid expense, some kind of accrual adjustment every month, and the annual amount. We don't want to double count that. So we only surface the P&L, but that means for anybody with a debt payment, we're only pulling out their interest payments. So you can see here our interest expenses, $1,200 per month, $1,250. The actual debt payment is $3,000. So I'm going to change that here and call it an actual debt payment. And you can see how significantly our forecast has changed already. It looks very different than when we first started. We've only tweaked 2 or 3 different numbers, but it's extremely accurate for what we're doing here. So, just reading my notes here, sorry. So here we've got our base forecast done. We reviewed the forecasting rules. We've looked at the logic, and we've kind of set it to what our base level assumptions are. So this is how the company is actually operating now. Everything else looks good to us, the sales, everything else. Some people will like to verify it using different views. And so the reason that I say that is because we built this with the small business user in mind. They're typically a little more visual. They like to see things graphically, whereas professionals might like to see things in spreadsheet type views. So we do have those built out. You can see that transaction listing type view exactly like my spreadsheet looked like, or you can see what I would call a more typical cash flow view, which is monthly columns and cash in and cash out with account balances under each. And so we provide both so that you can come and look at this and surface your data in a way that works with you. So, it's not just built for the small business user, it's also built for you, the professional. So we're trying to make everybody comfortable with the tools that they have. So I just wanted to highlight that. So of course, now we've got our base level set, and going back to Ryan's situation here, the design company, we've got their base level set for what's in the accounting system. We've reviewed it, all the data looks good to us, but what we are missing was what we said at the start was Ryan wants to grow, he wants to hire an employee, and he's got a $40,000 payment coming in the future. So just like a financial Excel model, we do want to add that information to our forecast. So we'll create the project here, excuse my typing. We'll put it into the sales account so that Helm can track it. And this is actually going to occur, presumably, because we actually don't know, this is presuming, this is our expectation, on August 15th, and it will be for $40,000. Sorry, just got to go a year, and you can now see the big jump in the payment, but we also need to add our new employee. We'll put that in the wages and salaries account, and we'll say we want to hire this person fairly quick because we either want to accelerate work on this project and get it done quicker, or we want to get more work. And so I would expect this person to probably start in June. So we'll put them on same pay frequency as our other pay runs, which is bi-weekly. And this person is getting paid, we said $4,000 a month, so $2,000 per pay run. So now we have a very good, accurate picture of where Ryan's design company is heading right now with the parameters that we've kind of established. They've got their $40,000 chunk coming in the future. They've hired their new person, presumably, and this is where we sit. And you can see that even though they're cash flow positive over time here, they do run into a bump here. And this is important to note because, again, that payroll cycle can impact people, as well as the timing of the project here impacted them as well. And so this is where Helm, in my opinion, really shines. We're going to start building out some scenarios. Let's add a scenario here where we get paid early. By scenario, what I mean is we're copying the entire data set of Ryan's design company here. So literally all of that forecasting that we did for the base case is all now in a new scenario called paid early. It's a completely independent data set. And so I can drag and drop, I can change dates, I can do whatever you want in this case without affecting my base case. So this project, what happens if it gets paid in July, say 15th? We can actually just simply drag it and drop it instead of manipulating the data in another spot. And we could actually immediately see what happens to Ryan's design company if you get paid early. We'll also make a case where what happens if they get paid late, because it's also good to know, best case, worst case. So that's kind of what we're doing here. So paid late, we'll change the color just so that we can tell the difference. And I'll just select that case here. And here we're going to say what happens if they pay it in September. So now you can see exactly the financial position Ryan will be in. If he gets paid early, he's going to be cash flush. He's got a problem if he gets it when he expects it, and he's going to have a real problem if he gets it when he's paid late. And so it's not to say that we have a solution here, but what we have is we can talk with Ryan as we're doing this, and we can start thinking about the solution. Ryan now has optics around what his business needs to do, and there's a multiple different solutions that he could do. I've just written down a few examples here. He could delay his own salary. Not ideal, but he could do it. They could get a line of credit. They could get short-term financing. Might be a little tight because, you're only a couple months out and those processes take time. You could accelerate the actual project. They've got a brand new employee, so they could focus all their efforts on that, finish the project earlier, get paid earlier. Or they could entice that person, the customer, to actually pay earlier by even giving a discount. The point here is that there's probably 1,000 different ways to skin this cat. You just need to sit down and figure out how to do it. The highlight here is that we got to that point very quickly and easily. So I'll just quickly map out what happens if he gets paid early with a 10% discount, because that actually is a plausible example. So we'll take this paid early case, we'll duplicate it, and we'll say less 10%. And I should have changed the color, so I'll do that now, just so that we can see what it looks like. And we'll go back into here and we will change this to $36,000, not 336, $36,000, because they're getting paid earlier, but perhaps they could incent the customer to pay them earlier without working harder on it. They could use their new employee for new revenue and just give them a simple discount. This is where their cash position would be. They'd still be in good shape, which maybe means they can now use their employee to grow the revenue instead of working on the same project and having even more lumpiness. So what I did want to show you is our dashboard, because this dashboard is pretty key in terms of what it shows you. If you're a professional like yourself, you're going to have multiple companies. And so here we've got Ryan's design company. If you can imagine, we had 10 clients on Helm. All 10 would show to the left side of the screen here, and they'd have this status bar. Here, Ryan's design company has orange. This is all based off the base case, which means he's average. If it was red, the bar would be less and it would be bright red. It means he's in a bad spot. And if it was full and green, it means he'd be in a good spot. So it gives you a very quick lay of the land in terms of where your customers sit and who maybe you should be focusing attention on. Now, we also give you this scorecard where it gives you a quick kind of lay of the land in terms of what's giving them that score. So we measure out cash available, net receivable, so accounts receivable less payables. We measure out your cash flow moving over time, so there's a positive or negative, what's the trajectory. We measure out your AR to AP gap, which it's more of a cash conversion cycle. So how long does it take for people to pay you versus how quickly do you pay your vendors? We calculate the difference there, as well as your cash buffer, which if you're a tech company, that's called runway, but it's basically saying if your revenue disappeared tomorrow, how much cash do you have in the bank to live based off your cash flow? And here you can see we've got 0.61 months, which is a big red flag, because typically we've also got these pop-ups in terms of guidance. Businesses should aim to have 2 to 3 months of buffer at any point in time. And if you had that 2 to 3 months, you'd have a green check mark. You can also see here that we provide green pluses, because actually having too much cash in some cases is a bad thing. It means you're not utilizing your capital efficiently. But the main point here, surfacing extremely quickly, is that we give you that visual display. You can hover over these icons and get feedback about it, which now gives you some parameters to help your client. Or if you're a business owner, it gives you some parameters with what you should be doing with your cash to improve your business, as well as your overall cash position and your cash flow score.